Look at the top-line metrics, and the American economy appears remarkably robust. Record-breaking corporate valuations and booming markets dominate the headlines, painting a picture of undeniable financial power. But beneath that polished surface, a severe structural weakness is expanding. A trillion-dollar deficit is quietly accumulating and putting pressure on millions of households, even as the broader indicators remain positive. This screen shows the constant, erratic swings of modern market data. While the overall trajectory looks like smooth growth, these daily fluctuations mask a system heavily dependent on borrowed capital. When credit outpaces actual income, the foundation becomes fragile. Across the country, households are noticing the gap between the optimistic statistics and their daily reality. Wages have increased, yet the actual purchasing power of those paychecks has steadily eroded. The system is not thriving on actual surplus. It is operating on a highly interconnected web of borrowed time, and the tension on that web is nearing its breaking point. The pressure starts at the checkout line. The cost of basic necessities has accelerated much faster than average wage growth, forcing difficult daily calculations. To bridge the gap between stagnant purchasing power and rising costs, families turn to the debt machine. High-interest credit is now routinely used to cover everyday living expenses. This chart shows how the math breaks down. The flat line at the bottom represents stagnant wages. The red line above it tracks the cost of living combined with climbing interest rates. As rates change, yesterday's loans compound into an inescapable mathematical trap. That same math applies to the housing market. Higher borrowing costs mean that for many, securing a standard mortgage is no longer financially viable. The American consumer, long considered the engine of global economic growth, has reached a point of exhaustion. The debt they carry is transitioning from a tool for growth into a systemic liability. This financial strain extends far beyond individual households. It is currently reshaping the physical infrastructure of major cities. The widespread adoption of remote work altered how corporations operate. Floors of once bustling corporate centers sit vacant, representing millions of square feet of unused space. These empty commercial spaces present a massive calculation error. Billions in property valuations rely on steady rental income that these buildings no longer generate. Those inflated valuations are sitting directly on the balance sheets of regional banks and institutional investors, who hold the massive loans on these rapidly depreciating properties. The commercial infrastructure built for the 20th century economy is misaligned with modern reality, creating a massive void in the banking sector. The final overarching pressure point exists at the federal level, where the national debt is expanding at an accelerating pace. Historically, government debt accumulated in temporary spikes during crises. This chart illustrates a departure. Modern borrowing is a continuous, escalating wave. This trajectory raises a critical problem. The cost of servicing it will outpace our capacity for actual economic expansion. With federal resources already stretched this thin, the government lacks the leverage to absorb failing commercial sectors or bail out struggling consumers without triggering severe inflation. Maxed out consumer credit, hollowed out commercial real estate, and surging federal deficits are all interconnected symptoms of a legacy financial system hitting its maximum load. The decay of these physical and fiscal structures is driving a fundamental migration of value. As the cost of maintaining 20th century systems becomes unsustainable, the economy is reorganizing around a different set of assets. As capital flees vacant office buildings, it is being reinvested into the data centers that facilitate remote work and automated commerce. These server racks are the new real estate, the essential physical hardware for an economy that prioritizes digital processing over physical presence. This shift creates a much faster, more volatile market environment. Traditional, slow-moving investments are being devalued in favor of high-speed digital assets and automated labor strategies that operate independently of the old debt-burdened consumer model. The greatest financial risk moving forward is attempting to apply 20th century logic to a landscape where the primary stores of value have already changed. The trillion-dollar shadow is the cost of holding on to a system that is no longer efficient. The coming years will reward those who recognize that the old rules of debt and property have already been overwritten.